Welcome to this segment of GTM Training Shorts, presented by GTM Training Institute, your source for comprehensive income tax compliance and tax provision learning and development. My name is Frank Nieves, Director and Practice Leader. Corporate tax can be complex, and understanding its terms and concepts can be challenging. GTM Training Shorts aims to simplify complex content into concise and comprehensible segments. In this short, we'll address the question, what is a deferred tax asset, aka a DTA? Listen to Anthony Toscano, tax manager in our Wayne office, as he explains.
Understanding what a deferred tax asset is, we need to understand the difference between book and tax. So there are differences in the way certain items are accounted for book purposes versus how they are accounted for tax purposes. These differences are commonly referred to as book to tax differences. In the US, we follow US GAAP for book purposes. Other countries follow International Foreign Reporting Standards, or IFRS, or other hybrid standards of accounting. The basis of book accounting is not important, but only whether there is a difference between the book and the tax method, and whether that difference is expected to reverse or not in the future. A book to tax difference can be either permanent or temporary. The IRS defers to the US GAAP rules as to what constitutes a permanent versus a temporary difference. Thus, the tax law does not categorize differences as permanent versus timing. It simply provides the rules of how to calculate what income is includable in the tax year and what expenses are allowable. The proper categorization between permanent and temporary doesn't affect taxable income or the amount of tax liability due for a tax year, but is important for a tax accounting point of view. A book to tax difference that does not have future tax implications is referred to as a permanent difference. This slide illustrates a few common examples of permanent differences. So these are items that will never be deductible for tax purposes or income that is never going to be taxed. Temporary differences relate to items that over time will result in the same amount of income or deduction for book and tax, but the items are recognized in different periods. So these are often referred to as timing differences, and these items will turn or flip over time. This slide illustrates a few common examples of temporary differences. So these are items that will be deductible or taxable for tax purposes, but they just might happen in different periods when recognized for book purposes. US GAAP through ASC 740 provides that in addition to recognizing the current tax that a business expects to pay, it should recognize the future tax consequences related to temporary differences. When recognizing the deferred tax amounts related to these future consequences, a deferred tax asset or liability will be booked to the balance sheet. When expenses are currently recognized for book purposes, but not for tax purposes, there is an unfavorable difference in the current year, causing taxable income to be higher than book income. If those differences are temporary in nature, we recognize the fact that in the future, this will reverse and book income will be higher than taxable income. We will book a DTA to recognize the future benefit we will receive. The same can be said for revenue currently recognized for tax purposes that will be recognized in a later period for book. And when a taxpayer has carryover items such as NOLs or capital loss carryovers, the future benefit of those items is also generally recognized as a DTA.
For more information on calculating and recording deferred tax assets, check out our Corporate Tax Provision Fundamentals ASC 740 program. Scan the QR code or email me for additional information or to suggest a future topic. Don't forget to like and subscribe below. Thank you.